our view is like, look, there are super smart investors on the board. We're here to get along, and we're going to assess up front to understand, okay, this is a company that wants to exit soon, or, oh, this is a company that wants a number of more years to develop this offering or that offering. And we need to be mindful of that going in. We're not going to go change the trajectory of any company. We're not going to fix things up or make things better. You know, at the end of the day, when you've got Founders Fund and Khosla and Benchmark and Keenan and all these great funds on your board, like they're smart people. They know what the heck's going on. It's not like we're going to change anything. And we need to come in understanding the long-term goals and visions of the board and the management team so that we are aligned with their goals and as opposed to trying to push a different agenda.
Hey, everyone. Welcome back to the Ignite podcast. Today, we're delighted to have Ken Sawyer on the program. He's the founder and managing director of Saints Capital. He has extensive experience in startups and venture capital, secondary investing, M&A, and a bunch of other things. He's been on some pretty impressive boards. And welcome to the program, Ken.
Thanks, Brian. Great to be here and great to have a chance to chat with you and your audience on all things venture and all things secondaries.
Yeah, so maybe for the audience, you could give a quick intro and then tell us what a secondary is.
Yeah, so I'm an old soul in the venture world. You know, it's often a young man's game these days. I've been doing this as a investor for over 24 years. Our fund's 24 years old, or our series of funds or firms 24 years old. And I've been in and around the venture world. I was an investment banker beforehand, selling companies and raising capital for companies and the like at a boutique investment bank for many, many years. And candidly, it's sort of an interesting story. My firm got bought in 2000. And so essentially almost everyone, it was the end of the dot-com crash, almost everyone got fired. And I had raised $11 million to invest in great companies that I came across as a result of my banking business. And the interesting thing is that all of a sudden, like, who wanted to invest in venture capital in the summer of 2000? It was like catching a falling knife. And so I spent some time to think about what's the opportunity set. And at the time, I was still a big believer in the internet. I was convinced the internet was going to change the world. And there were a lot of great companies here. And I wanted to stay investing. And obviously what we had was a lot of undeployed capital, but no companies. And the rest of the VC world had lots of VCs, lots of companies, and not much undeployed capital. And so we're really the first firm to say, hey, liquidity in the venture capital world will really be helpful for the industry overall. Let's actually buy some stakes in companies from folks who want capital, and let's see them through.
I love that. And, you know, the old phrase is history doesn't repeat, but it sure does rhyme. And, you know, definitely, 22, 23 very much felt like, 2001 and 2. And you kind of have the same kind of thing happening, right? You have this big run up, sky high valuations in the late 90s and also 2021. And then you have this new thing coming called AI. And back in the 90s, it was the new thing. It was the internet. And now, it's kind of interesting how.
Yeah, this is the third sort of what I call crash. I don't know if it's a crash, but a decline. We saw it obviously in 2000. We saw it in the world financial crisis in 2008. And obviously we saw these peak valuations that occurred, not dissimilar, as you point out, to the dot-com period of time in 1999. We saw these periods of unbelievably high valuations in 2022, and now a big decline. And one of the interesting things and why secondaries is so relevant is in the first time in the past decade, the distributions to investors in VC funds versus the amount of capital LP investors are putting in venture funds is below 1. It was 0.5 and 0.9 in 2022 and 2023. And that's the first year in a decade that we've seen distributions be less than the amount of capital returned to the investor community.
That's insane. So you have this, sky high valuation overhang, right? The valuations got bid way up, and you should have taken secondaries probably in 21, and you didn't. And now you're kind of stuck.
Yeah, we didn't invest much because we did think valuations were high. But yes, this is part of the dynamic. And I think what's becoming more, people like you who are great early stage investors are recognizing, I have this great skill to invest in early stage companies and make money. Do I know what's going to happen in the public markets, and how do I think about when to sell and when not to sell? Candidly, our advice is, there's never harm in taking some money off the table once you've extracted multiples on your investment. You don't need to necessarily sell your whole position, but selling some so that you can then get money back to your LPs and then they can help you with the next fund generations is a super thoughtful and intelligent thing to do. And how much you sell, that's up to you. But selling some, I was often criticized because we've had the policy of taking liquidity in some of our companies. We sold some in Facebook when they did a big tender. We kept 90% of our stake, but we sold 10% and got all of our original investment back plus some. And I don't regret that. Yeah, I would have made a lot more money if I didn't sell that small 10% of the stake I owned in Facebook when they did a private. But I got all the money back, I think 2.5 times our money back for our investors at that point in time. And I rode 90% of it. And that's not you don't feel stupid for doing that if you do that consistently, because as many Facebooks that went to the moon, there were a bunch of them that actually didn't. And I'm certainly glad that those we got some liquidity on as well.
Yeah, it's almost like an insurance policy, right? Yep. You invest in Facebook at a 5 or 10 cap, and now they're tendering at $1 billion, right? It's 100 or 200x kind of markup for you. And then you're kind of sitting there, you're managing other people's money, and you're starting to think about, okay, at what point do I take some money off the table here, right? It's the old Chinese phrase, you get rich by selling early, right? So yeah, tell us more about like how a GP like myself should think about that, managing other people's money, where I'm pooling, 50, 100 startups in this early stage venture fund, and you get one or two that pop.
So there's a timeline for GPs. So the first thing is that a GP can always take advantage of some liquidity when they've got their best companies. Typically your worst companies, no one wants to buy them, right? So you're not going to achieve liquidity on your worst companies. You're only going to achieve liquidity in the early stages of your fund life. So think of it as years 3 through 8 of your fund life. You can achieve liquidity as some of the guys that you did at your 10 cap are now worth $1 billion plus. You can take some money off the table in conjunction with a new round of financing. And doing some of that is just good common sense, right? Like everyone that took finance courses talk about diversification. It's true if you're a fund manager as well. What we spend a lot of time on as well is focusing on what happens after year 10. The average life of a venture fund today, the median, is 18 years. It is, Brian, your fund documents say, I got a 10-year fund life. The average venture fund, and of course, as an earlier stage investor, your fund life is likely to be longer to fully liquidate your entire portfolio. Today, there's over $1 trillion of net asset value in funds over 10 years old. Over 10 years old. So imagine, like we just did a transaction, for example, with a fund. We helped them liquidate funds 2 and 3. They were on fund 9. And they were about to raise fund 10. And so their LPs are saying, wait a second, you've got to give me some liquidity. Like you're raising fund 9 and I still have money in funds 2 and 3, not to mention 4, 5, 6, 7, 8. Okay. The thoughtful dynamic is that most of your IRR is baked by the time you get to 10 years. Selling the remaining assets or doing what's now popular called a continuation vehicle is something that's super interesting to LPs. And at the end of the day, as an investor, we all work for our LPs. They're our clients, right? What we do for our clients is we give them access to great companies and great investments, but our clients are fundamentally the investors that we have. And just as we think about being great stewards of capital to our investors, every VC like yourself should be also thoughtful about how do I serve the interests of my investors. And getting a K1 after 18 years of ownership is probably not serving your investor.
Yeah, that's absolutely crazy. I didn't know those stats. So I'm in year 10. I'm sitting there and I'm thinking about a 1-year extension. I have, let's just use round numbers, 100 startups, 20 or 30 have gone out of business, 20 or 30 have exited, and then I have 20 or 30 they're just hanging around, right? And now I'm thinking about, okay, I could do a continuation vehicle versus a secondary. Let's talk about the difference between those two and, how GPs and LPs should think about those.
So it's a great question. So the first thing is continuation vehicles are basically a relatively new concept. It sort of became popular in the buyout world maybe 8 years ago. And today in the secondary market, if you're a PE investor, about 50% of all the secondaries are actually these continuation vehicles. Keep in mind, the alternative to continuation vehicles is just selling your LP stake. That's a traditional secondary, okay? CVs have not been super popular in the venture capital world. We did one many years ago with Canaan Partners. There have been a few others, but we've done, I think, 45 GP transactions overall over the last decade or so. They're beginning to become more and more popular. And the reason that continuation vehicles are popular is that it allows the general partner to stay on the boards and continue to manage the investments. And it gives the limited partners an opportunity to either roll their investment into that vehicle or to cash it out, okay? And the reason that that's good is that at some point, okay, we've been in 12 years, do you want to continue with these investments or do you want to take your money and cash out? And it gives LPs an option and it allows the GP to continue managing the assets, okay? And continuation vehicles are typically popular in that 10 to 12 year period. At some point, as the assets get older and older, do you really want to manage a continuation vehicle when now you've got 8 other funds worth of portfolio companies? Should you just sell it? And this is a decision that every GP needs to make. There's no right or wrong answer. A continuation vehicle needs to be large enough with enough assets to support a transaction. And so there is a size thing. If you're left with just $15, $25 million of assets, you should probably just sell them. It's too small to do a continuation vehicle. But if you're left with a couple $100 million, it can be really attractive. And to give you a sense, we just completed a transaction with a GP. It was their 10th fund. And by the way, fabulous GP. They'd taken $1 billion from their limited partners. By the way, this is 17 years later. They've returned $3.3 billion to their investors. Crushed it. They did a great job on $1 billion fund.
And that's hard to do with $1 billion. To triple that money, that's a hard thing to do.
Hard to do. They had 17 companies left. Okay? Worth, I don't know, on their books, $60, $70 million. Okay? This did not make sense for them to do anything but to sell. Right? And we bought all 17 assets and we'll go forward. And look, it's not that they're not going to get liquidity from these 17 assets, like 2 will exit this year, 2 will exit next year. We'll just hold that and monetize it. Their LPs are done. By the way, when they sold those assets to us, yes, they sold it at a discount to net asset value. It didn't move the net multiple 1 decimal point. They still had a 3.3x. It didn't change it.
Right, because you're talking about 60, 70 million on a $3 billion fund.
Yeah. And it's just not.
It's like a rounding error almost.
Rounding error. And so at some stage, they become rounding errors. Now, by the way, there are some assets. We have another fund has $260 million of net asset value. Okay. And they'll transact as well. They've also returned actually almost 5x to their limited partners. And so even though it's really long in the tooth and there's a lot of quote NAV, the right answer for them, by the way, that was fund 2. They're on fund 6. Okay. So these are the types of transactions. And guess what? You want to go raise a new fund? Isn't it great to go give $150 million back to your limited partners and say, guess what? We're raising our new $300 million fund.
I got good news for you. I got $150 million coming into your accounts. And guess what? We have $1 billion fund we're raising. Yeah.
Exactly. Now, granted, this is being purchased at a discount to net asset value. So there's some concern. Oh, is that a fair price? We typically will have a fairness opinion with things, but we always say that limited partners and to GPs, if you don't want to take the price, you can roll into the same ownership you had before.
Yeah. So what is that typical discount? You're obviously underwriting it, and there's probably a range of values depending on the underlying assets and their strength and all that stuff. But can you give us a sense of like the high and low, the middle 80% or whatever?
It's a great question. And the answer is the high is a premium to net asset value and the low is zero price. You have to pay me to take it. So the reason that I say that, and I don't mean that jokingly, is discounts are often too focused on too much by GPs and LPs. And what I mean by that is we often see in companies we're an investor in that there are 5 other venture funds that have invested and none of the 5 are holding it at the same value. None. So explain to me if one guy is holding it at, say, a dollar and one guy is holding it at 70%, what's the discount? Well, it depends who's holding it. Is the value of the underlying asset any different if I'm holding it at 70 or 100? The answer is no. We don't care about discounts. We care about, as we say, we're going to invest for a reasonable return. Okay. Our goal is to get a reasonable return, an equity return. If you begrudge us an equity return, we're not going to agree on price. If you think it's okay that for a growth equity company, we're getting a, 20 to 30% IRR on our investment, we're going to agree on a price, right? And so that's sort of the approach we take. And what might be no discount for one GP might be a 50% discount for another GP. Now, that said, there are stats which I can share with you on what discounts look like today. And that always informs people a little bit about how to think about it. And I can actually compare it to some other asset classes. So let me see if my technology skills allow me to screen share. This shows discounts to NAV by all asset classes, okay? And you could look at in 2021, when the venture market was super hot, you can see that, oh, by the way, the discounts were not that dissimilar from what you saw in buyout deals and in real estate deals, okay? Or better than real estate deals. Now, the discounts on LP secondaries are approximately a little bit more than 30%. On direct deals, those discounts are closer to 50%. Now, that's a broad average. There are some assets that are trading at no discount, and some, as I mentioned, they're trading at a big discount. But this gives you a little bit of sense as to what do discounts look at and where have they been historically. And you can see that they're at a historical low for almost the past decade. And that's, in fact, due to the overall exit environment that we're living in at this point in time.
I would imagine the underwriting on this has to be such a chore, right? Because you're basically looking at the cap tables of these companies, and you're having to look at the entire lick-pref stack, right? All the side letters, all the different terms of all the different shares that are sitting out there. It must be a ton of work. Like, how long does it take to underwrite one of these GP portfolios?
You ask a really smart question. And it is something that many early stage VCs actually don't think enough about. Because as you know, as you layer on the most successful companies are going to raise a B and a C and a D and an E in some cases, and even F's and G's in some cases. Databricks and some of the great companies out there that we're talking about these days, of course, do that.
I think Stripe's on like series AA or BB right now.
And to that point, even though most venture funds hold their stock at the last round price, even if that last round price has $15 more per share of liquidation preference, and maybe it's a participating preferred or it gets a minimum 3x, so there's a ratchet in an IPO, there's all these factors that make that share of securities more valuable than a junior set of securities. And many investors don't appreciate that, because if you think about it, under all scenarios, the senior class will make at least as much, if not more, than the junior securities. So clearly, if I give you two cases, and one is under all scenarios, I'm going to get equal to or more than you do, that security is worth more. And so there are discounts for junior securities. And the question is, how much? And it depends. We looked at a secondary, and by the way, it was actually trading. Some family offices were buying this security in common. And it was a company that was doing perfectly well, I think 150 million of revenues, but they had $1.5 billion of liquidation preference on top of it. So what's common worth? Yeah, you can hope that there's an IPO that converts everything into common.
Collapses everybody to common, yeah.
But you got to get their permission, and in some cases there's a requirement to get a majority vote, and it doesn't meet the IPO threshold. There are all these things, and so we wouldn't pay a penny for that common share, even though this is a company that's worth maybe $1 billion or some number, certainly, a decent amount, but it wasn't growing, so the multiple won't be that high. And with $1.5 billion of preference on top, there's no price we would buy common shares at. But in any case, these are interesting questions that you have to consider, that often early stage venture investors and folks that are employees don't think of. And it is an important factor to consider. And so it's a really astute question, and one that, as there are more and more early stage investors in billion-dollar companies, this questions of how much liquidation exists will become a bigger and bigger question.
This is what, when VCs talk about ownership, this is what they're actually meaning, is like owning the right amount of the company at the right liquidation preference at the right part of the stack, so you don't get watered down to common or some low value share in the pref stack. That's what they're really talking about.
Absolutely. And another big point that I would make is it's not very well understood, and that leads to a lot of transactions at very different prices. And so if I can share another slide for you, I think this is informative. And one of the dynamics that occurs in the market today is that there are what I call 50 Craigslist or bulletin boards for private stocks.
There's over 50 now.
Over 50. And we are besieged probably by 100 some odd brokers every single day on shares for sale. Okay. This isn't NASDAQ or New York Stock Exchange, right? This is a combination of the bigger guys, the NASDAQ private markets and Forge and Shares Post and a whole bunch of folks, but also people you've never heard of, startups like Hive, and there are Seafront Capital sending out lists, and I could go on and on. But there are 50 Craigslist for private shares. What does that lead to? These are an example of 4 different Craigslists for private shares in the same security, listing them for sale. Okay? Look at this difference. 172%, 133%, 63%. This isn't spreads of a couple cents per share. This is like you were to go to NASDAQ and you'd find Microsoft for sale at $60. And then you'd go to the New York Stock Exchange and find Microsoft for sale for $25. Okay? People who trade in these shares have no idea what the market is. And so this is the inefficiency. And by the way, our goal is, we think we're such big fans of the venture asset class. We want to make the asset class succeed. And to make it succeed, liquidity is important. And these types of massive spreads do not lead to great outcomes for many venture capital firms because it's just too big a spread. Now, as an investor, I love telling my investors I'm taking advantage of this. We are exploiting. In fact, we'll often buy it.
Yeah, there's an arbitrage opportunity here for sure.
It is. And we will take advantage of that. And we have in certain cases where we bought a portfolio and we'll reduce our position by selling out at a very high price, something that we purchased at a much lower price.
Yeah. What do you think what the role is of the SEC in an inefficient market like this? Because this is exactly why the SEC was created, because of all these inefficiencies in stocks and arbitrage opportunities and creating transparency and regular reporting. Now that companies are staying private longer, sometimes 5 or 10 years longer than was the long-term average, just a couple decades ago. Are we going to face increased scrutiny coming down from the SEC into these private markets, or?
I doubt it. One of the things I would say is I totally echo your sentiments. The fact that I can buy these shares in a super inefficient market without disclosures and without, all the rules. By way of background, there was the 33 and 34 Act that says, hey, here's how you need to trade private, shares and the information disclosures and the rules and regulations. And we put that into place in our public markets. And yet today, as I often say, we have fewer public companies today than we did in 1984. Okay. What's happened to the U.S. economy? And by the way, this is true globally. What's happened to the global economy? We've grown more than doubled the global GDP in the last 20 some years. In fact, almost tripled it, right? However, the number of public securities that are out there have shrunk. What's happened to all the money has gone into private markets, and yet the rules and dynamics governing those private markets are not being enforced in the way that we enforce them in the public environment. Yet today, it's a very, very large part of our financial markets. And so I tell my investors all the time, this works for my favor. I'm an insider. I get the information. I know what's going on. I know how to price these, but no one else does, right? In the public markets, I'm competing with, an infinite number of people that have access, back to my Microsoft example, of the exact financial position of Microsoft, how it's trading, who's the owners, all sorts of things. You don't have any of that information in Databricks today.
That's amazing. Those are some amazing stats. And so like as an early stage investor investing in literal safes, so not even priced shares in most cases, what kinds of terms and side letters, and how do I protect myself as an early stage investor that's not reserving capital, right? I may do an SPV or two in an A or B to double down on my position for my LPs. Like how do I maintain on the cap table?
Well, I'm not a fan of safes, even though through one of our earlier funded funds, we of course invest them. You can't be an early stage investor today and just say, I'm not going to do safes. It just doesn't.
Unless you're a seed and lead, unless you're written like $1 million or $2 million check into seed rounds. Okay. Yeah. You'll do the priced.
And I do think there'll be more priced seeds, because I think there will be a trend back to priced seeds, in part because of sort of the tax, where you start the tax clock ticking, particularly in AI for
QSBS tax clock, right?
Exactly.
For people who aren't familiar with that, maybe you could tell us more about what that is and why that is important.
For founders, they get an exemption on $10 million where you pay no taxes, basically, if you have USBS qualified stock. And to get that USBS qualified stock, you can't sell it for 10 years. A safe note doesn't start that clock ticking. So you actually have to have a priced round to begin to start the 5-year period. And if you're a firm that spends the first 3 years just doing safe note A, and okay, I'll raise a more safe note at a higher cap, and oh, by the way, then I'll just do a that's a safe and supposed to an A as opposed to a price round, all of a sudden you're 3 years later. And if you get an acquisition offer 2 years, guess what? You just lost all that money on taxes because you don't qualify for USBS.
Both your investors lost it and the founder in this case, right?
Everyone.
Because the founder was now they have the capital gains that they're going to have to pay long-term, but still capital gains. And then the investors miss out on that tax exemption because of holding a price share for 5 years.
So I do think people will start, I think they won't be as popular in the future as they are today. Part of the dynamic that's created such popularity by safes is no one's been confident about what the pricing environment is, right? Pricing in 2022, right? We've seen even at the pre-seed and seed stage, and you know more about this than I, we've seen pricing come down a little bit, or at least flatten out.
Unless it's AI, blah-de-blah.
Certainly where I spend a lot of my time, which is the late stage companies, right? You ask about discounts. What's the discount on a round that was priced in 2022 at 15x revenue? Even if they've grown, they're probably not going to get that same multiple were they to go price today. And so people are using safe notes as a way. If you're a savvy entrepreneur, you're using safe notes to sort of kick the can, hoping that you grow into that valuation in the future. Most investors these days, if you're in the late stage, are saying, you know what, we're not doing a safe for that. But in the early stage dynamics, in particular, as the market, I think the market is stabilizing. We're seeing a lot more price rounds. You've probably seen this in Q1 and Q2 than we saw in the prior 4 quarters. So we're beginning to move, I think, back to priced rounds a little bit. But these are problems with safe notes because you don't have rights and privileges. There are tax issues, and there's governance issues, of course, as you know full well. And so I do hope we'll see a move away from that. From a secondary perspective, there have been some people who've tried to buy a safe note. Now, think of it from my perspective. Safe notes get a massive discount if you're on the secondary market. And so I also encourage investors that there's a big benefit to having a price round. Your discount's going to be less if you ever do need to sell that. And so I think we'll see a move towards more priced securities.
Yeah. So back to that original question. So I'm investing in safes. Is it I should invest in more priced to protect myself? Is there some sort of side letter I should get? Is it a bigger discount on the safe? Like, how do I protect myself as a early stage? And it's both from a GP perspective and also all my angels there on Team Ignite, right? We have thousands of angels that co-invest with us on these SPVs. What should they look for?
A big thing is make sure it's capped, okay? Make sure it's a post-money cap, not a pre-money cap, because then as they keep raising additional safes, your valuation doesn't change. If you have a pre-money cap and people do more and more safes, you don't get the benefit of that round. You actually get diluted from additional safes. So we're always saying post-money caps are really important, plus a discount. We want both, notwithstanding the Y Combinator sort of standard term sheet. You want both.
The exception to that, of course, would be the uncapped MFN, where you basically get the most favorable conversion. That's the 375 additional that YC now writes.
I would say, but we sort of believe in that as a dynamic. And then side letters to get pro rata rights, obviously important, because most safe notes don't have pro rata rights, and how that's defined is always a little bit of a tricky business.
But most pro rata rights expire upon that first price round anyway on a safe side letter.
That's what we would suggest from a side letter perspective. Makes a lot of sense to get you your pro rata rights there and do that.
They're not perpetual pro rata rights. It's typically they expire in the next price round. You have to renegotiate.
Yeah. Again, this is part of the dynamic. You have to, this is the Wild West, right?
It is. Everything's negotiable. It's kind of like, I did commercial real estate in my 20s, and, I brokered lots of sales and leases, and everything was negotiable, like every single term on that, term sheet.
So again, I think these are things that are important to think about as you go forward as an early stage investor. Again, we focus, because we're so late from a secondary perspective, we're not doing early secondaries for the most part. That's sort of something that we feel probably isn't the greatest thing. And we should comment on secondaries from the entrepreneur's perspective, because I know that's a big part of your audience. We published something in conjunction with a law firm and an accounting firm that helps entrepreneurs and founders understand the ramifications of doing a secondary and when it's good and when it's bad. The first thing I would say is like, there's just like we would tell investors, diversify your assets. Most cases, these entrepreneurs, all of their eggs are in one basket. And for years and decades, and I'm an old school guy, like we love that. Like they're really focused on getting to an exit. By the same token, we have to be realistic. And I think the world of investors have matured in their view towards secondaries and concluded that some amount of secondary at some point in time is reasonable, as long as it's not changing the motivation of the entrepreneur. And so we also provide guidebooks for boards who are considering secondaries and how to think about it. So the first thing we'd say to an entrepreneur is like, yeah, if you need to buy a house, you just had a kid or whatever, and this is a stress in your life that you don't have enough money, for sure, secondary makes a ton of sense. But a couple things. Number one, make sure you still have all your eggs, so to speak, all your eggs but one in that basket.
You don't want to sell like 80% of your shares so you can get $3 or $4 million to buy some Silicon Valley house, right?
Yeah. So that's number one. Number two is remember that you're leading a bunch of other people that are aligned with your mission, and don't treat yourself differently than you treat the rest of your team. Okay. Now that can be, hey, some of my team members only been there 6 months. Should they be able? No. But if you're saying, hey, I'm being able to sell X percent of my stock that's been vested for X number of years, take that rule and apply it to everyone else in your organization.
Yeah. For anybody who's vested, which, at that point, by the time you're getting to a secondary, you might have 50 people, 100 people that are vested with you. They've been on the cap table on that common, and, give them the opportunity to sell 5 or 10% of their shares and wet their beaks.
Yeah. And I think it's a sign that you're adding value, that they're worth more. And it's a sign that you think of yourself sort of in the same way as you think of your teammates. And the concept that I'm going to get liquidity, but I'm not going to allow anyone else to me, isn't the way we would advise our CEOs and entrepreneurs to approach a secondary. And in that regard, I think it's important to think that as well is like, as a secondary, allowing one in, thinking about who's your investor, I often think is just as important as it is in the primary basis. You don't always get to choose in some extent, but I think thinking about the types of investors that are going to be helpful on your cap table over a long-term perspective. And we like to say, look, we've had over 55 IPOs of our companies. We like to say that our name on the cap table is one that's respected because we've been in a bunch of IPOs. Now, maybe that's sort of self-serving and pat yourself on the back.
I think that's important if you're selling yourself to, a GP and LP and all the founders underlying there, all those cap tables, and you're basically saying, hey, not only I'm going to provide liquidity, but I can down the road also help.
Yeah, and we like to say as well, like, it is important who's on your cap table. It does matter, and you want to be thoughtful about that, and having a qualified purchaser and a supportive investor, like a lot of the biggest fears that we have when we come on cap tables is like, oh, do you not want to sell over the next 5 years? Or, oh, are you going to change management? And our view is like, look, there are super smart investors on the board. We're here to get along, and we're going to assess up front to understand, okay, this is a company that wants to exit soon, or, oh, this is a company that wants a number of more years to develop this offering or that offering. And we need to be mindful of that going in. We're not going to go change the trajectory of any company. We're not going to fix things up or make things better. You know, at the end of the day, when you've got Founders Fund and Khosla and Benchmark and Keenan and all these great funds on your board, like they're smart people. They know what the heck's going on. It's not like we're going to change anything. And we need to come in understanding the long-term goals and visions of the board and the management team so that we are aligned with their goals, and as opposed to trying to push a different agenda.
Yeah, that definitely makes sense. So as a GP managing a large portfolio of companies, because, you know, Team Ignite's a very high volume investor. We do 100, maybe 150 per fund. How do I set up my data room for the future? When I get to that year 10, 11, 12, and I'm calling you up in 10 years and I'm saying, hey, Ken, thanks for being on the podcast 10 years ago. Now I got, 30 companies for you to underwrite and, get an assessment for. Like, what kinds of things should I have in my data room ready to go?
Great question. And I'd say it's a couple things, first of all, to mention.
I'm in secondary class with everybody right now on the Ignite podcast. This is great.
So the first thing I'd say is that the good secondary funds, the big secondary funds like ours, we're an RIA, okay? That means we need to get an audit, okay? That means that if we can't get enough information about enough of your assets to be able to get an unqualified audit opinion, we can't buy it, period, okay? There may be some small sort of sub-$100 million funds out there that don't have to register as an RIA, and they may not require that, but you're really, really, really limiting yourself if you can't have enough information that allows us to get an audit.
And so what are some of the must-haves per company to get that unqualified opinion?
So the first thing I would say is, and this is not well known, under both California and Delaware law, it's not true in all states, but if you're in New York, California, or Delaware, under those state laws, there's a ability for any investor to get basic information that by law must be delivered by the underlying portfolio company. And that includes historical financials, cap table, and operative documents, the articles of incorporation, those types of things.
That's any investor, regardless of the percentage, you got one share of the common, you by law, within a certain remedy period, can demand that information.
I won't go into all the details. One of the particular rules is they can require you to go on site to see that information as opposed to sending it to you.
Cool. Come get it.
Come get it.
Yeah. Come to our office.
It's the come get it rule. But everyone does it now. A lot of companies sometimes say, we're not going to give you any information.
So I don't actually have to get information rights. My side letter is useless, basically.
No, information rights provide for generally much more than are what's required under California or New York or Delaware law, for example. So information rights are really helpful, and getting information rights is a big benefit because it's clear they're going to send you the information, right? And that can be quarterly information and forecasts and a whole bunch of other things that's typically in information rights, whereas the legal rights under Delaware law are really limited to, historical audited, an audit and cap table and a few things. So not much. But at a minimum, you can get that. And if you get that, firms like us can get an audit. But many folks don't regularly get information, and as a result, often don't have that available to them. So that's the first thing, is to do that. And that process of collecting information, what are the articles of incorporation and the updated rights of first refusal and co-sale rights, the shareholder rights agreement, all these things that you may be subject to, most early investors don't keep a good record of, okay? Because you got a whole slew of companies and you're a really small investor by the time they do a bunch of these things. So that makes it hard for a lot of these folks to do secondaries because you just don't have any information, right? And if you don't have information, it's really hard to value something, even great companies, unless they've done a really recent round, right? So that's the first thing, is keep good records of tracking all of this information throughout the life of your fund and keep up to date on it. And it does add an extra burden, but it does open up these possibilities of providing.
Just keep filing those files away, right? In folders for the future, basically. Just be organized.
And so that's a key thing that we'd focus on. And one of the other things I would say that's really relative, very important, and one of the reasons that my firm, Saints, has been so successful is most venture firms operate under what's called the VCOC exemption, the Venture Capital Operating Company exemption. And that means you don't have to do the same reporting, email archiving, audits, and all sorts of stuff that are required by the SEC if you're an RIA. And if you do more than 20%, or you do, let's just say, simplified, a large secondary transaction, you often will queer your VCOC exemption and you'll have to register as an RIA. And then when you register for an RIA, you got to get compliance people, and it just adds a whole level of cost and complexity.
Sorry, what was the mechanism in which you convert to an RIA and you have no choice? What is that mechanism?
I won't go into all the legal details, but long story short is if you do a reasonably sizable secondary transaction, you will then have to register. There's an exemption. If you do less than 20% of your capital in secondaries, you can still keep your VCOC exemption. But once you do a big secondary transaction, because that fund, you're doing it on the entire fund, effectively you become an RIA and have to register. We provide a solution for GPs to do that, where we act as the RIA and they can continue to sort of manage the assets, but we have some ultimate control that allows us to ensure that we do it that way. And that's a big factor for VCs to consider, like, hey, do I have a partner to do this with, or am I going to end up having to register? And most angel or small pre-seed and seed funds really do not want to register as a RIA. It is
why is that?
Cost.
It's just the
cost, and you got to have a compliance firm that comes in. You have to archive your emails. You have to adhere to all sorts of marketing rules and regulations. You have to report your returns in a certain way. There's a whole variety of complicated dynamics. You have to go through an audit every couple of years. It's complicated, time-consuming, and expensive.
Another topic that some of our listeners might be interested in is, okay, I see a lot of secondaries floating across AngelList or whatever other, site. So I can invest in, you name the big companies, SpaceX, Anthropic. I've seen those. I've seen, a few big, well-known multi-decacorn, centacorn secondaries. So I'm just an angel investor throwing some, 5, 10K, 25K, whatever, of my hard-earned cash at these secondary SPV kind of offerings. Like, what should I how do I conduct due diligence? I'm just a small fish here. Like, what do I look for? And how should I go about that?
Well, there are people that just think that there was a smart other firm that priced it and I'm going to pay that price. And I think that that's often I think you're gambling. I don't think you're investing, candidly. We get LPs who call us all the time and say, hey, I just got offered Anthropic. It's a 2 and 20 vehicle. And it's a 5% premium to the last round. I'm like, by the way, FTX is selling a bunch of shares at a 30% discount with no fee and carry. Maybe you ought to buy those. And they're like, oh, I had no idea. And we see people offering SPVs at prices where there are direct shares for sale at much lower prices. I remember I was raising money, and I was talking to a family office, and they said, oh, we bought Palantir this February and at $11, and they just raised around at 15, and they got great investors. And why do I need to invest in a secondary fund? And I said to him, you don't, but we also bought Palantir, actually a preferred security, Series E, not a common security, and we paid $3.30 a share. Now, by the way, Palantir we sold, and they sold around $25 a share. They made a 2.5x. Great, looks good, right? Not bad. Now, we had bought the same month at a much lower price and made a much higher return. We told that family office, you'd probably be better investing with us and paying us some fee and carry to get a $3.30 price versus an $11 price, right?
This is the same argument I have with family offices about investing in my fund. I'm like, great, how many pre-seed and seed deals are you looking at every month? And how many of those are you actually able to get on the cap table? Because founders aren't like, oh, I'd love to have a family office on my cap table. Unless you have some sort of unique value add, like you made all your money in exactly their vertical or their sector, they're not going to take your money just because you have money.
And most of these people doing these SPVs, they don't know anything about the company other than what's in the public information. We'll often say, oh, show us your data room. They don't even know financials. So yes, they've got great investors in there. That's all they can say. But they don't really know much else other than that. And as I say, to me, that's a little bit more like gambling than it is investing. And we like to think of ourselves as investors and think of us as we're going to go look at the financials. We're going to look at the multiples. We're going to make some assumptions about when they exit and what valuation and so forth. As a result, we don't invest in the SpaceXs of the world, as great a company as that is. It is a retail stock today driven by investors that are, for the most part, in the secondary market, driven for, more sort of investing in a name to say, oh, I invested in SpaceX, as opposed to these are the underlying returns I think I'm going to get from that investment. And that's not to demean SpaceX at all. It's an incredibly great company. I sure wish I'd invested in many, many, many years ago. But we think of doing things a little bit different as a professional investor, much like you would do in terms of diligence.
You could invest in Elon's next company, Grok. It's only like a $15 billion cap and no revenue. You might want to do that.
Yeah. X.AI. We've seen a lot of SPVs out there for all these companies. So
yeah, a lot of SPVs on that one. Buyer beware. So what's FTX for the LPs out there?
I'm sorry?
You mentioned FTX. You can find their shares on FTX.
Well, no, FTX did a secondary. They had owned a large share of an AI company, and they did a secondary. And again, this is not private information. They sold at a valuation that was a discount to the prior round, and there were a bunch of bidders in that dynamic. And we and many others looked at it from a secondary perspective because you could buy shares there cheaper than all these SPVs that are going around there that are out there to do transactions.
2 and 20 management fees, escalating carry. I've seen SPVs on SPVs. So like it's an SPV into another SPV. And so there's like stacking carry on and management fees.
Yeah. I bemoan the old days. In the old days, you were a VC and you called another VC because you thought they would be helpful to the company and you wanted them on the cap table and there was no promote or anything else. Today, you go in and you call your family offices and your other investors and say, come in. I know you're not going to help me any, but I can promote you. I can get some economics on your co-invest. And that's, it's sad for me. It's a different industry where, 20 years ago, there was there were some negative things about the business too. It was an old boys network and, mostly Harvard and Stanford grads. And so I'm glad that we've seen the industry expand to a whole bunch of new names and faces into the industry. But what I do regret is that this sense of camaraderie of co-investing, the true sense of a co-investor, has diminished a lot in a world where everyone's creating an SPV and charging fee and carry on it.
Yeah, I love that. Well, we're almost out of time. Last question would be kind of, looking into your 5-10 year crystal ball for secondaries and venture generally. What are some things you're excited or that you predict to be happening over the next decade or so?
We're going to see a massive growth in venture secondaries. We've seen you can chart the growth of funds and how much capital has been invested in primary venture capital funds. And that dynamic is going to just accelerate the need for liquidity. It's not like in 5 years from now, we're going to see funds that are now all getting liquidity within 10 years. They're going to continue to have companies still going to stay private longer. Hopefully we will have more IPOs, but the need for secondary is going to be prevalent. And just to give you a sense of how small the secondary market is compared to the rest of the world. Today, just in dry powder, there's about $2.4 trillion of dry powder in VC and private equity at the end of 2023, okay? They'll invest $860 billion is I think the estimate of dollars deployed in 2024. So think of that as 2.5 times dry powder to the amount invested. Keep in mind, $860 billion. The total market for secondaries, PE and venture, is today, 2024, maybe $150-160 billion, right? 20% of what will go into the market from a primary basis this year alone. Interestingly, though, there's $145 billion of dry powder, not even enough dry powder to invest in the market size this year, okay? That is how underfunded secondaries are overall. 10 years, 5 years from now, we are going to see the amount of money in secondaries triple, and we're going to see the amount of money in venture secondaries triple, and the amount of money in secondaries overall double. Okay, and ventures will grow more quickly because the need is more significant. And as I say to people, secondaries can be your friend. They're a liquidity tool to give you money back to your investors, to crystallize carried interest, to create new vehicles that will extend the timeline. These are tools that VC funds, LPs, and entrepreneurs are going to use increasingly over the next 5 to 10 years.
Amazing. Yeah. And it's kind of, it's the way I think about it is it's a little down funnel from all the other VC and private equity money raised, right? Like the industry keeps growing. So secondaries has to keep growing too, 5 to 10 years later.
Exactly right. Exactly right. And that's what we're betting on. And as I say, we really focus on we want secondaries, to be a net benefit to the ecosystem. We want it to help entrepreneurs. We want it to help general partners. We want to help angel investors. We want to do that in a thoughtful and responsible way that both gives them money back, pays them a fair price, and de-risks the opportunity while still providing a reasonable return for our LPs. And I think in that world, things will improve the overall ecosystem.
Love it. Do you have time for a couple minutes of rapid fire?
Sure.
Let's do it. What is the most rewarding investment you've made?
Well, everyone always points to the most rewarding investment as the return that they made the most from. I think, selfishly, there have been some investments that we've made that may not have been the best returners from a multiple of investments, but still have been good returners that have also changed society a little bit. We just sold an investment actually to a PE firm that helped improve policing. It helped identify, using software based on a big data set, sort of officers that may be more susceptible to actions that aren't consistent with police sort of guidelines. And it recommends training and other things to prevent that event from occurring. And they can identify 2 to 8% of the police officers that are most likely to have an adverse event. And how can we provide them more help and more training in advance? Those types of things where you're making the world a better place and using software and technology to do it are always some of the most rewarding.
I love those. Yeah. The ones that have social impact and in addition to the profit, right? Like, yeah, let's make money, but also improve the world. Those are the ones you feel the best about. Who's your biggest inspiration in the business world?
Well, I think there's no question that there's been one firm that has performed above and beyond all else, and that's being Sequoia. And the team at Sequoia, from Mike and Doug and some of the folks that have subsequently retired, to some of the new guys that are really incredible and have been able to sustain. It's hard to sustain excellence for such a period of time.
Especially intergenerational excellence, right?
Really, really, really hard to do. I often tell the story when I started, the firms that were the best were firms like Sutter Hill and Weispeck and Greer and Kleiner Perkins, and Kleiner's still around, but a lot of the other firms have gone on and created a bunch of other firms, which I also think is a sign of success. But it's really incredible what the Sequoia team has done in terms of being able to have such sustained excellence in an industry.
Yeah, pretty amazing. What's a book that significantly influenced your career?
I don't know about career-wise. I like to read books that are sort of broader in scope than per se industry type books. I was actually just at a seminar here at the Aspen Institute this weekend, and we were talking a little bit about sort of the Cold War. We had a seminar on the Cold War. And one of my favorite books is a book by Tina Rosenberg called The Haunted Land. And the reason that I like it is the last episode of the book talks about the East German guards, some of whom shot the last people climbing over the wall and some of whom who didn't. And how the humanity of both of those people and their upbringings and the dynamics around those decisions that are incredibly difficult life and humanity decisions, right? To think about that, you're following orders and you're some poor kid from East Germany and you don't know any better versus these people who, through some courage of conviction and belief, chose not to act when they were instructed to do so. And that book follows the trial of some of the folks that actually made the wrong decision in this case. And so I find those questions of humanity ultimately what we love to do in the world of entrepreneurship. We love backing these people who are incredibly mission driven And it reminds me to a large extent about this question of where is that core humanity inside of you, and how do you think about changing the world?
Yeah, I love that. Last question. What's a common misconception people have about venture capital and secondaries?
Well, the most common misperception is about secondaries. I think CBS Market Watch said, that I was Silicon Valley's garbage collector. And I think there's often the perception that
They said that about you and your firm?
yeah, there's often the perception that no good venture capital firm would ever sell anything of great value to another venture capital firm. And that only garbage would get sold to secondary firms like us. Obviously, since then, we've done investments in everything from Palantir and One Medical and Facebook and a whole bunch of really amazing companies. But I think that's a common misperception that it isn't there. And I often say, yeah, and one super smart hedge fund sells some eBay to another super smart hedge fund, and no one thinks they're collecting garbage. So that's the most common.
Maybe if you're trading in like penny stocks. Yeah, you're not trading in penny stocks. You're trading in bona fide companies that just haven't exited yet.
Exactly. That's exactly right.
Well, Ken, thank you so much for coming on the program. Where can people find out more about you and your firm?
You can always go to www.saintscapital.com, our website that talks about us. But everyone else, can also feel free to reach out to me on LinkedIn or other x.com these days, or any other place that they see fit.
Twitter X. I hear a lot of people just say Twitter X.
And Twitter X, yeah.
Twitter X, yeah, X Twitter. That's Twitter X, yeah. Anyway, thanks so much for coming on. It was such a great episode. I think people are going to get a tremendous amount of value. I learned a ton, so thank you for that. Thank you so much.
Awesome. Thanks for hosting. Great to see you, Brian.